This parafuel question is related to the two topics. One was the NPV and the other topic was the real options. The other topic was the real options. The following information relates to investment A, where parafuels continue to produce paraffin from crude oil using traditional theory or the traditional technology. The initial investment in the production facility will be 14 million. Tax allowable deduction is available on the production facility at an annual rate of 25%, reducing balance in year 1 to 3. At the end of year 4, any remaining return on value can be written off as a balancing adjustment. So, examiner is saying to you whatever the value would be at the end of the 4th year, that can be write off. As with production facilities of this nature, there will be no residual value after the 25-year project life because of substantial decommissioning cost. So now students were very confused that now the examiner has tested in this question a project with a life of 25 years. That was when the students see that this project is for the 25 years. So that was giving the students a tough time that how to solve this. Now, sale revenue in year 1 is expected to be 12.75 million. And this is expected to increase by 5% per year in each of year 2 to 4. The examiner has already told you what will be the sale price. Production costs are expected to be 5.25 million in year 1. The pre-inflation amounts for year 2 to 4 are given below. These are the pre-inflation amount and we have to incorporate the inflations as well. The pre-inflations for year 2 to 4 are given below, as are the annual inflationary rates for production cost in year 2 to 4. So these are the annual rates per year. These are the per year rates. Now, it is anticipated that the working capital will be 10% of the sale revenue will be needed in year 1 to 4 at the start of each year, and no additional working capital will be needed in year 5 to 25. At the end of 25 years, it is expected that the working capital will be required for the decommissioning cost and will not be released. So this is again an assumption is this question. Now, the parafuel company pays tax at a rate of 20% on profit in year in which the tax liability occurs. The tax on losses is refunded in the year in which the losses occurs. The examiner has told you that the losses on the losses, what will happen? The refund will be given. An estimate has been made up of the discounted values of the post-tax cash flows from year 5 to 25. So the examiner has already given you the post-tax cash flows for the year 5 to 25. This total 5.4 million at the start of year 5. Okay. So this was the data which was relating to your investment A. Now there was currently the new technology used to convert household waste into paraffin is expensive to set up and run, although setup and running costs are expected to reduce once this technology becomes established. So now, from this paragraph, it is seen that in the previously, when the company is making the paraffin from the crude oil, examiner told you in the first paragraph that the company is using the old technology. Now they are new technology they are going to use. But what is happening when you are converting your waste into paraffin? It is expensive, but they are saying it will reduce when this technology will be established, the new technology. Now this is initial setup cost for the investment B. First part was for the investment A. Now for the investment B. using the new technology are estimated to be 34.6 million. So this is the initial cost. Due to high cost and lower revenues initially, the after-tax free cash flows generated by this investment are expected to be 1.4 million in year one. These are expected to increase by 40% in each of the year two and three. In year four, when cost reduces and revenue increases, the after-tax free cash flow is expected to be twice as much as the year three amount. Due to a high level of uncertainty with investment B, it is expected that annual after-tax free cash flows from year 5 to 25 will remain same as year 4. It is possible. This is an underestimate, and in future more realistic amounts can be determined. The annuity factor for the 12% cost of capital and based on a useful life of 25 years is 7.843. The examiner has used this annuity factor. Now, this is a Caro Innovations company has suggested it may offer to purchase investment B at the start of year 4 for 27 million. Due to the uncertainties surrounding this investment, the cash flows are expected to vary a standard deviation of 40%. The risk-free rate is estimated to be 5%. Now, why the examiner has given you people this data? What was the reason for that? Because now, up to this point, the investment A and the investment B, we will be using to compute the NPV analysis. But when when there is a purchaser to buy your investment B, now this option will be a real option. Now this option will be a real option. And which real option? Real option, put option. Real option, put option. Why? Because now there is an investor, the Caro Innovations. He has made an offer to purchase investment. You know that there are the three types of the real options. One is the option to delay. One is the option to go for follow-on products. And the third one is the option to abandon. That is the put option. Mean in the abandon, you will be selling your project to another party. So we will be seeing in the case of the real option and it is a put option, what would be the values for PA and the PEs. Then the standard deviation has been given to you, risk-free rate has been given to you, and the time period will be at the start of year 4, so it will be the 3 years you can say. Now, in the last paragraph, Parafuel Company board met to discuss adopting the new technology for its production facility replacement based on converting household waste into paraffin. So now what they are going to do, the new technology they are going to, for its production facility replacement, they are going to replace their production facility with the new technology. Now, the company's CEO gave an enthusiastic talk about the need for Parafuels company to fulfill its environmental, social, and governance responsibilities. The chief marketing officer pointed out that it is likely that the airlines around the world will face increasing pressure on environmental, social, and governance agendas, and in particular, how they are helping to protect the environment. However, the CMO, the Chief Marketing Officer, also said the airline will need to ensure that this type of jet fuel is safe to use. Mean, as this company is doing the para fuels, the company is doing the fuels means the business. So what they are going to do, they are going to change the technology, and they are with the technology they are replacing their production facility. So whether the airline industries that they are using the fuels, so what will be happen? They will ensure that now that is the company is fulfilling its environmental, social, and governance responsibility. Now there was another comment, and what was that? The chief financial officer was more cautious. She pointed out the fact that there is no binding contract with Kera Innovations company. The Kera Innovations was the buyer. She also said that while parafuel companies shareholders would be supportive of the company pursuing an environmental agenda, the majority of the shareholders will be concerned if that led to a significant negative impact on their corporate value. The CFO reminded the BOD, although only one production facility needed to be replaced very soon, more will need to be replaced after 2 years. So this was the concern of the CFO. And the third point was, nevertheless, the CFO suggested that if this new technology become established and produces jet fuel, which is safe to use, Parafuel will get the benefit of being one of the first companies to adopt the new technology for the production facility. This could be advantageous in terms of cost reduction and the revenue maximization. So this was me say the all about your question. Now what is going to happen? What are the requirement of the question? See now. Can you see guys? Explain why parafuel company might include the value of potential offer from Caro Innovations when considering investment B. Now, examiner is asking you that why there is a need. Why? There is a need for the real options. The Caro Innovation is giving you the offer, and that offer is a type of the real option, put option. So examiner is asking you why, what is the need for that? What is the need for that? And in the B part, prepare a report for the board of directors. Calculate the net present value of the investment A. So traditional technology, just net present value we have to compute. In the second part, the estimate net present value of investment B before taking account of the potential offer from Caro company. So this is again only the NPV calculation. And then the estimate of the net present value of investment B after taking account of the potential offer from the Caro innovation. So this is when you have to apply the bsop model. And now examiner is asking, based upon the financial grounds, whether investment A or investment B should be undertaken and discuss the assumptions made in the calculations. This should be done prior to discussing the comments made at the BOD meeting. And in the last part, examiner is asking, discuss the comments made at the BOD meeting and suggest how parafuel company may wish to proceed if the new technology will be introduced. So this was the all about your question. Now, both of you, uh, I am asking you people, uh, Miss Ria and Uzma, anybody of you have opened the question with you?
No, sir, I don't have the question and I am unable.
My screen is visible to you.
Yes, sir.
Now see, the traditional net present value investment appraisal method assume that investment needs to be taken on now or never basis, and once undertaken, it cannot be reversed. Like when your NPV of the project is coming positive, we say we will accept the project, otherwise we will reject the project. And if we have started a project, we cannot withdraw our funds until we finish. Most investments have within them certain amounts of flexibility. These are the points which you must means write down if the examiner is asking. Certain amounts of flexibility, such as whether or not to undertake the investments immediately, or to delay the decision, or not to pursue the follow-on opportunities, or whether to discontinue investment opportunities after it has started. This flexibility known as a real option and can be valuable for companies such as parafuel companies. Now, what is going to happen? The Cara innovation is potentially offering parafuels company the opportunity to discontinue with investment B because they are ready to buy the company. If it felt that this opportunity is not worth pursuing, even though the project has already started, parafuel company does not have to continue the investment for 25 years. Now, what is going to happen? If it was a simple NPV calculation, and as you know, the whether it is a project A or the project B, both the projects are for the 25 years. But after some years, we came to know that the project is not giving us any value. So if it had been a normal NPV phenomena, so we cannot withdraw our funds now. But if you are following the real option method and you see that the project is not worthwhile for us, so what will happen with the help of the real option? You can sell that project at any point whenever you see that the project is not giving you any value. So what is happening as the purchaser is offering you to buy at the start of year 4, so it will be abundant after 3 years. This also gives para opportunity to judge like commercial success of the new household based products to paraffin conversion process. This is a real option and the black shore model gives a method of valuing this opportunity which is similar to a put option. Parafuel company can consider this value within its project assessment. So this was a very, I will suggest that very good, you said the difference between the NPV and the real option. Everyone clear about this? Clear?
Yes.
Okay, now the other part of the question was in which examiner asks you people to perform the investment NPV. We have to perform the NPV analysis. We are doing the NPV analysis, and that is for our investment A. Farhan,
Yes, sir.
how are you?
Assalamu alaikum.
Farhan, have you done this question before, brother?
Sir, little bit, but not properly.
Okay. Now see guys, what is going to happen? This investment A is having a total lifespan of 25 years. But what is going to happen? Examiner first have given you the data for the 4 years. We are having here 0, 1, 2, 3, and 4. Now, as this is just a simple NPV analysis, so first of all, you will state here the sales. Miss Uzma, can you hear me?
Yes, sir.
Miss, what is the sales in the first year?
$12.75 million.
I am taking here the 1,000 common, okay?
Okay.
So it will be 12750.
Yes.
What are the sales in year 2?
It is expected to increase 5%
Yes, so
per
just
year.
increase the figure 12750 multiply by
13,387.5.
so 13,388. What about the other figures? Year 3 and the 4.
14,056.8.
14,057. And the last
14,759.7. 14,760.
14,760. This was the sales. Just we have inflated the figures. Sales inflated. Now, the other figure, the other cash flow was the production cost.
So we are not taking the inflation rate in the sales revenue.
We, it had to be inflated or not? The sale revenue had to be inflated or not? Just hold on. See, this was 12.75 million and this is expected to increase by 5% per year in each of the year 2 to 4.
Yes.
Okay. Now, what are the production costs? The production cost working should be there. And why the production cost working should be there? See now. We are having Production cost. Okay, now, what was the production cost in year 1? Tell me.
5,250.
As this is the year 1 cost, so this is already inflated. How much this was?
5,250.
This should not be inflated because that is already the year 1 figure. Okay. How you will compute the year 2 figure? What was the year 2 production cost that has been given to you? And examiner mentioned that these are the pre-inflationary cost. So what was that? 6,200
Yes, 6,200.
multiply by what was the rate of inflation? 6%. So 1.06 raised to power 1. So what is this figure coming?
67, 65, 72.
And now what is the year 3 figure? The cost was 7,100 multiply by the 1.06
1.0.
and
Yeah.
1.07. How much this is coming? 8053. And this figure was 8,000 multiply by 1.06, 1.07, 1.08. So 9799. Clear everyone? Farhan? What is
Yes,
happening?
sir.
These
Yes,
all
sir.
figures have been given to you at year 1 price and cost levels. So as this is already inflated, this was, if you have to move towards year 2, this is year 1 figure. So just inflate with the 1 year inflation and that will be your 2 figure. This is again the year 1 figure. So to arrive at year 3, add the 2 years inflation. This is again the year 1 figure. So to arrive at the year 4, add the 3 years inflation. Clear everyone? Now place the figures here. Your production costs are 5250, 6572, 8053, and 9799. Okay, now what is your tax allowable depreciation? Again, you can perform the working. Okay, now what was the cost? Can you tell me? We are having here 1, 2, 3, and 4. Written down value and the capital allowances. Usma, what is the cost? 14,000.
14, yes, 14,000.
This is 14,000 and the capital allowances are 25%. So how much?
25%.
So this will be 3,500. What is the
2,500.
balance? 14,000 minus 3,500. Farhan, please do the calculation, brother.
10,500.
10,500 and then again compute the 25%. 2,625.
2,625.
Okay, then what is the balance?
7,875.
How much?
7,875.
Again compute the allowances. 1,969.
1,969.
And what is this value coming?
5,906.
And examiner told you all this will be depreciated. Okay. Because there is no scrap value. This all. So this figure will become the part of the performer. This is 3500, 2625, 1969, 5906. What are your taxable cash flows? Tell me.
4,000.
4,000, 4191.
Yes.
Ria, please perform the calculation.
Yes, sir.
Ria, don't lose hope. If I am giving you people this opportunity, so please utilize it. What was the rate of tax?
20%.
So apply the tax. 4,000 multiplied 20%, it will be 800.
800.
Then
838.
okay, 807.
807.
And in the last, as this is the loss, the examiner mentioned on the loss, we can claim the refund. So it will be
189.
189. Now add back your capital losses. Farhan, are you getting, brother?
Yes, sir. I was performing on Excel.
Good. Please perform and you may send me as well after the class. Okay. I highly appreciate. Okay, now guys, what will happen? Still, you will be having a requirement of the working capital as well. So perform here the working tree, and that will be for the working capital. Okay, now what is going to happen? You know that whenever there is a working capital, so the number first step is we have to calculate the working capital required, and then we can compute the working capital change. Examiner said to you that this is required for 4 years. So we are having year 0, 1, 2, 3, and 4. Okay. Working capital was how much? 10% of the sales. So as this is the sales, so take the 10%, it will be 1275. This will be placed in year 0 because the working capital is needed in the year 0. How much? 1275. This is what would be the figure? 1339. Then 1406. And it will be 1476. Okay. Now, examiner mentioned that this will not recover in the last year. See, if I told you people, see now, no additional working capital will be required in year 5 to 5. At the end of year 25, it is expected that the working capital will be required for the decommissioning cost and will not be released. Will not be released. Now, just compute the change, guys, in the year 0. it will be the same 1275. Then compute the change. What is the change coming? As this is increasing. How much?
64,
64. Then
67,
67. Then
70.
70. Now, do not recover it in the last year because this is the assumption in the question that the working capital will not be recovered. Okay. So the working capital, it will be 1275. 64. 67. 70. Here nothing. Now, what is your investment? There was 14,000. Okay. Now these are your total cash flow. -15,275 negative. 66636. 5911. 5127. And this would be 5150. Now, examiner has given you the discount factor at rate of 12%. Now, again, I will mention to get the marks on the analysis skill, do not write down the discount factors in your Excel sheet. Instead of just apply the subtract sheet functionality, apply the NPV formula. What you have to apply, guys? NPV formula. Now, I am stating directly here the present values. This will be 15275 negative 5925 4712 3649 and 3273. These are the present values. But remember, this is only for the 4 years. There is a still factor because the project life is from 5 to 25 years. Still, the overall project life is 25 years. Now, what is going to happen now, guys? Can anyone tell me how you will be completing? Examiner already told you the cash flow for year 5 to 25. How much was the cash flow? See, from year 5 to, these are the post-tax cash flow. How much? 5.40 at the start of year 5. And these are the made of discounted value of the post-tax cash flow. How much that was, guys? 5.40 million. So, you will be taking here the 5,400. But remember, as this cash flow will remain same for this remaining years, so here the concept is being applied. What was the concept? The delayed annuity. What was the concept? The delayed annuity. And delayed annuity says whatever your present value is, you have to further multiply with the previous year discount factor. So as in this question, the delayed annuity is starting from year 5. So you will further multiply it with the year 4 discount factor, and that will be 1.12 raised to power -4. So this value will be coming as 3432. This is this value, the present value. Now this is this value. So guys, can you tell me what will be your NPV? Your NPV will be coming as 5716. Take all these positive values, this one, this, this, and this. Add these and minus 15275. Is this coming, Uzma?
Yes, sir.
Okay.
Sir,
Yes.
sir, instead of calculating present value, we can simply put the formula of
Yeah, yeah.
NPV.
Yeah, you can put. But you see, here what will happen, brother? The
No, no,
54.
first we
Yeah,
will
the first.
include
Yeah. First.
first we calculate the delayed annuity, then we will perform the NPV function.
Yeah. You can do. Clear, everyone? Ria,
Yes, sir.
this was for the investment A. But the next question was, we have to perform the investment B. Again, this investment B lifespan is also 25 years, but the examiner has already made the things very easy for you people. And what was that? The examiner already told you that what will be the free after tax cash flows. Examiner has given to you the free cash flow generated by investment 1.4 million, then it will increase by 40%. Okay, so the examiner made the things easy, and then examiner said that the annual tax cash flows from year 5 will remain the same as year 4, and this is another estimate. So the examiner has used the 12% cost of capital. Now, let's do this now. We are having year 0, 1, 2, 3, 4. We have already been given the present value of cash flow. This was our investment, and that is 34,600. In year 1, how much was, Uzma? 1,400.
1,400.
Okay. Then 1,960. Then 2,744, just inflating with the rate. And the last one will be 5,488. Okay, these were the, sorry, these were the not present values, these were the cash flows. Now, as discount factor again, here is the 12%. So I am stating here the present values, this will be the same. This will be 1250, 1563, and this will be 1953, and this will be 3488. And how these figures are coming, just I am calculating one thing for you. Ms. Uzma, tell me, what is the discount factor at 12% for year 1? What is this? Farhan,
Sir, can you repeat? Your voice got stuck.
I am asking what is the discount factor at 1% or at 12% for year 1?
0.8928.
0.8928.
8928.
So multiply 0.892 with the 1400, this figure is coming.
Yes, sir. It is 8928, 893. It's coming. 1250.
Okay, now what will happen for the cash flows of year 5 to 25? Now see what the examiner told you people. Examiner told you people, due to a high level of uncertainty, it is expected that the annual after-tax free cash flows will remain same as year 4. It is possible that this is an underestimate and the future more realistic. The annuity factor, see now, how the examiner has confused yourself here. Examiner has given you the 25 years annuity factor. Actually, we do not need the 25-year annuity factor here because the 4 years data we have already computed. So only how many years are left out of 25? The 21 years. Examiner again check the students that what the students will do. See, examiner said that the cash flows will remain same. So what are the cash flows? These are the cash flows. These are the cash flows. Now, see what is going to happen. You will be multiplying with 7.843. This was the annuity factor for all the 25 years. But out of that, the 4 years data we have already performed. This value is for the 21 years. So guys, out of this, deduct the annuity factor for 4 years. Tell me, Ms. Osma, what will be the annuity factor at a rate of 12% for 4 years?
0.636.
Not annuity factor I am asking, not the discount
Sorry,
factor.
sorry. 3.037.
3 point.
3.10. 3.0.
So are you understanding why we deduct this? Because this value is for 21 years. So accordingly, the discount factor should be used for the annuity factor. So how much this value is coming? This is coming 26,375. Now add up all the values and tell me what will the NPV coming. The NPV will be coming approximately 29,000. Clear? Clear both of you? Miss,
Yes.
just give me 1 minute. Of the PA and the PE. Now, first of all, everyone means both of you remember one thing. Most of the time, the students make a mistake in this. And what is that? Whenever it is a real option, whenever it is a real option and put option. So the PA will be the present value of cash flows foregone and the PE will be the sales proceeds for which you are going to sell your project. Now, in this question, the K company is saying to you to sell the project at the start of year 4. So, guys, this cash flow you will forego. Along with this cash flow, you will forego. These both cash flows will be foregone. So, what will be the total cash flows foregone? 3, 4, 88 plus 2, 6, 375. What is this value coming? Uzma?
29,863.
29,863. And the sales proceed, the value which they are offering to you, that is 27 million. So that is the 27,000. Okay. And remember, this is the put option. And you are going to sell the asset after 3 years. What is the risk-free rate in this question? The risk-free rate is 5%. It will be 0.05. Always put into the CB practice platform, break the percentages. And the standard deviation is 40%. It will be 0.4 and time is 3 years. Clear? Now see, just put on the figures into this formula. What is your PA coming, guys? Tell me. The PA we have just concluded 29,863. 29,863. Now, what is your okay now? What is your other value was coming? 27,000. Okay. What was the risk-free rate? 0.05. Sorry, this is the, yes, 0.05. What is the time? 3 years. And what was the standard deviation? 0.40. See, guys, the formula has been automatically done. And what is the value? See now, most of the students, they will be working here in a wrong way. And they will be taking the value of the call option. That option is not required by you. For you, the P option, the put value is valid. For you, the put option is valid. You will not select here the call option value. And why our answer is not coming here? Means say the good one, because we have taken here the figures in the total 1,000. So you can take here the things in the million. So the answer will be correct. See, if I take here instead of the 1,000, I take here 29.863. This is 29.863. I am taking here the millions now. And this is I am taking here the 27. You see, the same figures would be there, but now see the 10.95 is the call option and this is 4.33 put option. So for you, which option is valid, miss? Call option or put option?
Put option.
Put option. So you will tell the examiner that what is going to happen previously when we are having without real option, our NPV was coming 29,000. But now with real option, this will be 29,000 plus 4, how much it will be? As we have taken the 1000 common. So that value was coming as 4330. So this total value means your overall project value will be enhanced. Okay, and this will come as 4359. Now, what is going to happen, guys? This was the examiner basically asking from you people. So, Ms. Osma, can you tell me whether this question was difficult? It was a straightforward question. What do you say?
Yes, sir.
Ria, what do you say? The question was difficult?
No.
Now see, as we have to go for the professional marks as well. In this question, the report format you will follow, and with the report format, you will easily gain the marks. Like this is C now. Always in the report, there must be a report heading, like the report to the board of directors. Always there must be introductory paragraph. Now, this reports always remember one thing. The report introduction is nothing. It is just the whatever the requirements of the question, just copy paste that. Like this report provides whether the production facility which needs to be replaced should use traditional technology or the new technology. Based on this, it makes an initial recommendation. The report discusses the assumptions made. The report then discuss comments made at the BOD meeting and suggest how Parafuels company may want to proceed if the new technology is adopted. So basically, this is what? This is all the requirement of that part. Now, see, if you have to gain the marks of the analysis and evaluation, this is the best explanation which have been given here. What you will do, guys? See, when you are telling the examiner the investment A I have performed in the appendix 1, you are gaining the marks for the analysis. The investment B, you are saying in appendix 2, but this was prior taking of the offer of the Cairo Innovations, and then you have calculated including the offers from the Cairo Innovation using the bsop model. Now, investment B without considering the offer from K only gives a marginal positive value. See, this was only the 29,000. And when the potential offer from K is considered, then this is 4359000 is less than the value. See, now with the option, the value was this 4359000, and even the investment A was giving the higher value. So based on these values, investment A should undertaken. This is you are applying the analysis and evaluation. What you are doing? Analysis and evaluation technique you have applied. Whenever you are discussing the assumption, this is the professional skepticism. You are challenging the assumption. You are challenging the missing data. You are challenging whether the assumption used are realistic. Now see, what are the assumptions used? There are many assumptions. It is assumed that the input figures in the computations for both projects, such as sale revenue, cost, working capital, and then inflation figures are correct. The accuracy of these may need to be assessed. It is also assumed that the tax rate will remain the same during the project, and this is unlikely to be true. So guys, see, whatever the figures, you have the sales, the tax figures, the inflation figures. Now, both projects are very long-term projects, and the assumption basis of determining the figures from year 5 to year 25 needs to be closely examined for reasonableness. Question needs to be asked, on what basis investment B cash flows remain same? You know, examiner told you people that for the investment B, the cash flows from year 5 to 25, that will be the same for year 4. On what basis this assumption has been set? How likely this to be the case? How has the present value of cash flows for investment A from year 5 to onwards has been determined. Now, parafuel cost of capital. You see, we have discounted both of the projects at 12%. So we do not know how that 12% has been calculated. Now, if we talk about the bsop model, using the bsop model, the standard deviation or the volatility of the underlying assets is needed. And the bsop assume that this can be estimated accurately. This is the assumption of this model. This may possible for frequently traded products, but this is not the case for one-off projects and the new project. So guys, when this model is assuming that you can find the standard deviation or the volatility of the underlying asset with the accuracy, this is valid only for the frequently traded products, but not for such projects which was we are going for one-off. Such is estimation difficult to and often significant errors. Therefore, the assumption of the accuracy of the volatility measure is questionable. See, we are questioning what we are doing, all the things we are applying the skepticism. Now, the bsop model assumes that markets are frictionless and the project's cash flows follow a long normal distribution, both of which are reasonable assumptions for market traded products, but not necessary for investment projects. Guys, I will highly recommend that these are the best explanations. You know that in the bsop model, we use a normal distribution table. Okay. The bsop model assumes that once determined, the variables will not change, but in reality, they may do. In order to estimate the value of current valuation offer for investment, which was the 27 million, Paraffin assumed that the offer is binding, but currently it is only a potential offer. They have just showed their intentions. They have not done a meeting with you. Okay? Understand, Usma?
Yes, sir.
Now the last part of the question in which examiner was asking the board minutes points were, these were the board minutes. So now examiner is asking response to the board of directors meeting on the replacement of the production facility. What was happening? They were discussing that they had to replace their production facility. What will the impact? In the first paragraph or in the first comment, adherence to environmental, social, and governance aspects are becoming increasingly important criteria by which to judge a company as a corporate citizen from the perspective of all stakeholder groups, including investors. So, when the companies are following this social, environmental, and governance, so the companies are being considered as a good corporate citizens. Whether parafuel company decides to undertake the replacement of the production facility with traditional technology, which use crude oil, or the new technology using household waste, this will impact on the company's expected environmental responsibilities, the perception of how it discharges these, and thereby impacting its reputation as a good corporate citizen. Now, the examiner is trying to explain you people here, whatever the technology you are using, whether it is the old one, whether it is the new one, what is going to happen as you are going to make the crude oil. With the crude oil, the paraffin is being made. So how you are wasting, see what the examiner is saying, whatever you are using or the new technology, this will impact upon the expected environmental responsibility because you are using household waste. This will impact on company expected environmental responsibilities, the preparation of how it discharge these, and thereby impacting its reputation as a good corporate citizen. This is probably what the chief executive officer is referring to. However, the BOD should equally be cautious about pursuing an agenda which compromises parafuel's financial strength. As the chief marketing officer suggests that airline companies will be concerned about their responsibilities with respect to the environment, and using this type of jet fuel would be significant help in achieving a high level of environmental protection. Now, The chief marketing officer was suggesting one thing, and what was that? It is likely that the airline around the world will face increasing pressure on the environmental, social, and the governance agendas, and particular how they are helping to protect the environment. Hmm. The CMO was in the opinion that whatever the parafuel, if it is going to use the new technology, with the new technology, they are going to make again the crude oil or the whatever it is being. So if the airline industries are using them, so definitely the airlines are concerned that how or what impact they will be having on their environmental issues. So definitely if they are using that, so they have a confidence in the parafuels. So therefore both parafuel company and its customers, the airline companies are in agreement. The airline will be naturally concerned about the safety aspects of the new product. However, once the new type of jet fuel is proven to be as safe as the current type of jet fuel, these concerns should dissipate and the sales revenue will probably increase rapidly. So only when this new fuel, which is going to be produced with the help of the new technology, it is being said that it is safe to use, then it is okay. Now the chief finance officer has put forward the argument that financially parafuel company does not benefit from moving the new technology currently. Furthermore, whereas there should be a positive uplift once the fuel is deemed safe, the current computations do not necessarily show this. The CFO appears to be concerned that if more production facilities are replaced with the new technology, this will reduce the company's and its shareholder value. This was the concern here. See, what was she said that while para companies shareholder would be supportive of the company pursuing an environmental agenda, the majority of the shareholder will be concerned if that led to a significant negative impact on the corporate value. So what he was, the CFO reminded the BOD, although only one production facility needs to be replaced very soon, more will be needed replaced after 2 years. So now this is being explained here. The CFO appears to be concerned that if more production facilities are replaced with the new technology, this will reduce company and its shareholder value. It is possible that over the coming 2 years, para company fuels will have a much better knowledge of the new type of jet fuel and it is safety. Therefore, computations will be more reliable and might well show a substantial positive value certain impact. So this was again having a good means say that conversation. He was of the opinion that instead of changing the all production facilities with the new technology, we should do step by step. When we are familiar with it, when we are familiar with it over the time, then we should do it and we can have the maximum benefits instead of we are doing or we are changing all our production facilities with the new technology. And the last part of the question was CFO suggested that the new technology become established and produce jet fuel which is safe to use. Parafuel company will get the benefit of being one of the first companies to adopt the new technology for the production facility. And this will be advantageous in the terms of cost reduction and the revenue maximization. Now again, the significant advantage of for parafuel company, if it went through the new technology, it is an early adopter. It should benefit from positive learning curve, very important, and ways to make production of the fuel jet more efficient than would be the case if they continue with their traditional technology. This would result in reducing of ongoing cost. The setup cost in the future may also reduce if the company establishes better ways of constructing production facilities needed in 2 years. Revenues may also increase as parafuel company will have more time to build better customer networks and relations, and a better marketing strategy would be there and built around the fuel coming from the adoption of the new technology. So guys, again, this is a very good point. What will happen? That examiners said that if they are going for the new technology, so they will be the first learner. They will be having the first learner, the positive learning effect would be there. They will be having a proper know-how, the proper knowledge of that. So what will happen in the future when they will be having a total learning of that. They will be having already a built up relationship with the customers, with the suppliers. They will be having their marketing strategies. They will be having their advertising strategies. So with the passage of time, when the things will be on hand, so their cost will reduce, but their sales will increase. But on the spot, this is seems that it is costly, but with the passage of time, due to the impact of the learning effect, the things will be smooth. Now the how the how should para company should proceed? Now the company should launch a public relation campaign to highlight its environmental credentials, build its reputation, and thereby hopefully increase its corporate value. So first of all, a campaign should be there. The public relations. The company should also launch a public relation campaign to ensure that its investor that aims to maximize long-term corporate value, and this move to new technology is very much in keeping with that. Since there may be safety concerns initially, the company may want to support research investigations to assess the safety of the fuel, including functional support, especially in conjunction with airline companies involved in this research and possibly other interested companies such as Cairo Innovations Company. The company should put in place effective process to maximize learning opportunities from the investment made in the first production facility. It should use learning to reduce cost and to produce more accurate estimates where possible, reduce uncertainties of the cash flow forecast. The company should ask Care Innovations to make a formal contractual offer and possibly align in 2 years when it will be need to make further decisions in case new technology proves not to be feasible. So guys, this is a very good question. I will highly recommend you. Then now how as you are going to have adoption of the new technology. So before the new technology, you should have the campaigns, you should advertise, you should advertise in such a way that the people know it that if you are going to change your technology, so what will happen? Your processes will be safe, the people will rely on you, and then when the project is going on, so then if you have any means say the misunderstanding, then you can have a buyer like that of the K company, and you can have a formal contract with them that how they will be buying your company and so on. So as this is a conclusion, guys, sorry, report, so there be a conclusion must be there, and then the report compiled by and the date. Clear, both of you?
Yes.